Hello, everyone. Welcome to this very special webinar focusing on the Resourcing Tomorrow conference hosted by Minds and Money on December 3rd through 5th in London. I'm your host, Corey Fleck. You might recognize me from the Corlin Economics Report, radio show and podcast covering the resource sector, talking to analysts, fund managers, and companies, both large and small, throughout the resource sector. I am joined by three very important guests, all ranging from fund managers, portfolio managers, equity analysts. I have Amanda Van Dyke joining me. She is from the Critical Minerals Association. Marcos Camhis, he is the managing director at FOS Associates, as well as Paul Renken, senior geologist and equity analyst at VSA Capital. Now, again, this is focusing on the Resourcing Tomorrow conference. We're going to be focusing on critical minerals, how critical minerals will continue to play a role in the energy transition, and discussing how the juniors and earlier stage companies will fit into this transition. Just as a, I guess, overarching theme here, I want to kick off this show by getting each of our guests' opinion on critical minerals, over the overall size of the market and how they see this market continuing to grow. And then we will filter down into, again, how these juniors and earlier stage companies can benefit, and even more importantly, the financing environment around these companies. Amanda, let's start off with you. Again, you're from the Critical Minerals Association. Can you provide us with some general data around critical minerals? They've come into the spotlight a lot more over the last, let's say, 3 years. They're a growing sector, but they're still a relatively small sector. Can you give us some data around just the overall size of critical minerals and their market capitalization, please?
So it does partially depend on what you're going to call a critical mineral. So moving one step backwards, critical minerals are, every country has its own critical minerals list. And that list is, all it means is a mineral that's essential to your economy in some way, as in either whether it's the energy transition of your economy, your manufacturing, your economics, and that there is a supply challenge or a looming supply challenge that makes the strategic security of your supply an issue. So a good example of that would be something like potash. Potash is really, really essential to making sure we can grow enough crops. But, Canada's got lots of it. It's not critical to Canada. They've got tons of it. It might be very critical to a place like India that can't secure access to it. On the other hand, what most people often think of as critical minerals are battery minerals or energy transition minerals. And that's what's getting all the headlines. And that's because it's a whole new, it's largely a new suite of minerals. Some that we've known for a very long time, things like copper and things like nickel, which both have very large, robust, well-known markets. And then there's much, much smaller markets like graphite, which is essential in just about every battery formulation on the planet uses graphite. Natural graphite vastly outperforms synthetic graphite for performance in batteries. But this market is the global graphite market is less than 1% of the global copper market, for example. And so when you're looking to, double, triple, quadruple production over a time period, it's far less attractive to major investors and far less understood than trying to understand getting a piece of the copper market. And that's what the challenge is. When you're talking to investors, you're often talking about extremely niche markets that they have no familiarity with. And what they also see in those markets is opaque pricing, because these are often not exchange traded metals. So there's no exchange trade for lithium or graphite. And so they're very opaque, and they see huge volatility in pricing, because every time a new mine comes on, there's a slight oversupply in the market that makes the price come crashing down. And there's nothing like volatility to scare an investor. Volatility in an opaque niche market is equal to fear in the minds of most investors. So if you are if you do want to invest in critical minerals, because you know that you're going to need, by 2050, like just some big stats, they think we're going to need to use based on today's supply, we're going to need to produce between 5 and 10 times more graphite per year, lithium and graphite per year than we presently produce. Which you're like, yay, excitement. Why isn't money pouring into this? It's not pouring in because right now, graphite and lithium are very slightly oversupplied and their prices are quite low. So it can't attract investment. Now, will they go up in the future? Quite likely. When you have demand that's that big, it's kind of hard for the price not to go up. But we're going to actually have to go into deficit before investors respond, in my opinion.
Yeah, we always see investors coming in late to markets. That was a very good overview of just how much need or demand is coming for some of these metals. But you're right. These are small sectors. So, Marcos, let's get you in here. And as a veteran fund manager, how can you even go about allocating some of your fund to generally these small sectors? Even though we see that they're growing, they're small sectors. So, how does a fund manager even start to get exposure into, let's say, critical minerals companies?
Thank you, Corey, and great to be here again. Thank you for having me on this webinar. I've been running investments into the mining sector, primarily on the private equity side, but also in the public markets for the last 10 years. I think just as an overarching comment, I think critical minerals are certainly here to stay. The demand is increasing, and the policy-making environment is such that is pushing in this direction. As Amanda mentioned, the US policies, the EU policies, and their lists and policy-making coming out of that are very important because they are driving some of these markets and they're creating opportunities for investors. For me, looking at junior miners, I think it's very important to be diversified because there are projects that may never take off and others that will be successful. So diversification is key. You cannot just bet on one company and hope that their project will take off. Volatility is something that one has to be extremely comfortable with because we have seen metal prices, especially in some critical minerals, have wide volatility and wild volatility, especially in the past year. And also one has to be very aware and very tuned into geopolitical changes. I'll mention the example of nickel, where I'm mostly exposed. We've seen a complete shakeup of the nickel market with increased production coming out of Indonesia. And this has affected a lot of junior and not so junior miners, with some companies actually going completely out of business. I think nickel is a good example of junior miners that may completely fail or their stocks be completely diminished because of large geopolitical moves, and in some cases not so much because of individual projects failing. I'll stop here and we can continue the conversation.
Sure. Well, Paul, let's bring you in and let's get you to put on both of your hats here. One being a senior geologist, one being an equity analyst. These minerals aren't new. They just haven't all of a sudden appeared. They have been around, but now we're getting more interest in these minerals. So one question being, deposit-wise, discovery-wise, are there still major discoveries to be made in a lot of these critical minerals? And as an equity analyst, especially when you're looking at the juniors, do you simply just need to focus on either discoveries, assets that are already defined, or newer assets, new discoveries?
I can remember a report that actually got published right before the year 2000, roughly, that would question whether or not we could really pursue a electrification of the economy because there simply wasn't enough lithium in the world to be found. That was such a gross inaccuracy.
Yeah, that's changed, hasn't it?
It was such a gross inaccuracy simply because, as a geologist, we've known that there's plenty of lithium out there in various styles of deposits. But the problem was the marketplace was so small at that time that it was a very niche product, which there just wasn't any money in it, and particularly for large institutional investment and large industry in order to pursue it. That's why it took NASA, for instance, in order to make the first commercial lithium-ion battery, for instance, and they did that specifically such that they had electric power, which was portable, that didn't need fueling when they took it up to the lunar lander on the Apollo missions up to the moon. But now it's a whole different story that we have here, and lithium, of course, is in wide demand, but it's also in widely placed across the world in this point. As far as the other materials are concerned, to deliver electrification and the battery critical minerals agenda, yes, there is plenty of it out there in various styles of deposits. It's geologically understood. The concentrations, however, of these materials are such, maybe quite disseminated or otherwise sparse within rock deposits or brine deposits and that sort of thing. A lot of times the technology hasn't been developed previously in order to pursue just how do we make money at trying to extract these things in order to get them both out of the ground, but also technologically delivered into the products that we need to see for electrification. So that's another issue to be dealt with. But yes, there's plenty of that material out there. Now, the other question comes down to is where's the money in order to pursue all this? And that's where equity investment comes in, because it tends to take the highest level of risk, both in private companies and in public companies. But the problem is the marketplace is otherwise so niche that there's very few investors to pursue many of these things. One of the things we heard during LME week, for instance, right now, is issues around supply for gallium, germanium, which go into semiconductors, or for rhenium, which goes into jet engines. Well, those are part of the periodic table, which at most is only a few thousand tons of total metal, on an annual basis needed globally. But the thing is it's growing so fast in these particular materials that it's really become an issue in the supply chains. So, and if there's no investors or hardly any investors out there outside of the industries that use these materials, which actually understand them, and the commercial numbers are around trying to produce and purify these materials and manufacture them, then that becomes a real issue.
It is. Okay, Amanda, let's get back to you then, because you said one thing that I think is so critical to all this, is that sometimes there's no public pricing model for these commodities, these minerals, and that provides a lot of challenges for companies to not only get funding from investors, but to also comfortably move projects forward, especially if they're building a mine or however they produce these metals. Could the government step in, or is this also on corporations, as we've seen in the critical minerals space, where other sort of OEMs, let's call them, have come into the sector and said, look, we will take all of your material or some of your material at a set price for the next 5 to 10 to even 20 years. Does this help shore up early stage capital for companies to find and build mines? Amanda, you are muted.
So I have to slightly correct you.
Sure.
You are right that combination that OEMs, for example, have offered to step in and both help finance and take 100% of the offtake of a number of these companies. But I have yet to see one of these OEMs or any of these companies willing to help finance a company. And they can only finance when they largely de-risk at any price. It's simply not, unless the set price is extremely low and probably below market, the likelihood of them setting that price, it's always in market terms. Now, they might be willing to pay a small premium. And when I say small, I'm talking 5, maybe 10%. If they can secure 100% of the offtake, and they can also ensure that offtake, they have full transparent visibility over the manner in which it's being extracted, processed, and delivered to them, because that has value to them based on their own production regulations in their own countries, and lower carbon pricing can potentially help them in their end pricing of their product. But the truth is, I can't think of one product or one offtake agreement I've ever seen that has guaranteed a premium price, guaranteed either a price or B, a premium price for any product. I've actually seen discounts in order to secure that 100% offtake within the context of the market. And I think that the market needs to kind of give up on this idea that they're going to get a premium for having clean, green product. I think they should be really happy to get an offtake that has a pricing model that they can afford. And increasingly, that's going to be difficult because none of them will do it. So what you're seeing, it's an old-fashioned thing. It's a collar, a cap and a collar. So we will pay you this percentage of the market price for your offtake with a cap of X and a collar below. So that collar means you can't lose money because you won't ever get less than this, and more than something else. Now you need an offtake agreement if you want to finance production, but those agreements for offtake are very difficult to get, and the pricing is extremely complex. And even more difficult is the fact that most of these junior companies there's no precedent. There's about 1 million precedents out there for copper and gold offtakes, right? People know how to write those contracts. Nobody knows how to write a lithium or a graphite offtake agreement with dynamic pricing. And very often these junior mining companies that are signing them are, to be honest, quite naive. They don't understand the complexities of long-term financing that the company is going to require once it's in production. So yes, offtakes are required to get them into production. They're key. No, and frankly, you should think twice about investing in a company that doesn't have some form of an offtake arrangement, because it's a huge de-risking element for an investor. But you need to really scrutinize the pricing on that offtake arrangement to know that the company in question will be able to successfully get into production in what will inevitably be a volatile pricing environment.
So then I guess to the main point, what I was trying to get at with that question is, what will improve the financing environment for the juniors? It's tough in almost any minerals or metals space right now. Critical minerals are even smaller. So what, in your eyes, improves the financing environment?
I think that companies need to get more professional and more mature and understand that it's not just, everyone in this room has seen thousands of junior mining pitch books in front of them. And they inevitably start with some huge macro data that I gave you earlier, that by 2050, to meet energy transition goals, we're going to need to produce 10 times more lithium per annum. Everyone's seen that stat. But the lithium price went up 10 times and crashed down 10 times over the course of 3 years, despite the fact that we are using more lithium every single year, right? And that scared everyone in the market. And so right now, you're gonna have to, junior miners are gonna have to, and I don't mean to massively pitch the resourcing tomorrow, but the level of maturity and sophistication that you're going to have to show a really good understanding of not just how to get your asset out of the ground, but how to sell it, how to market it, how to deal with your carbon taxation issues, which are coming, whether you like it or not. Investors need to see that you've considered every aspect, more than just having a big resource in the ground. Being a geologist and saying, I found, the next biggest lithium deposit in the world is unimportant. What you need to know is, did you find that lithium? Is it in the bottom of the cost curve, which is just about the only place to invest in the mining world right now? And can I secure sales? How can I prove to you that I have a buyer for my product sufficient that I can attract the 5 or 10 different kinds of financing, partially from development banks, partially from the equity markets, partially from the lending markets, and partially from the royalty and offtake markets, because it takes a village to finance a mine. And to do that, you need to check every single one of their risk boxes, and they've got hundreds of risk boxes. And junior miners, the world where they could just go drill a few holes and say, you know, I found 2 million ounces of gold, pay me. That world's over. You need to be a sophisticated mine developer with a really good understanding of global critical minerals markets if you intend to get financing for your mine and to rise above, because there's thousands of companies out there that want financing for their critical minerals projects. Maybe 10% are going to get it, and that 10% are going to be the ones who can answer every question about what it's going to take to get their product to market.
Absolutely. Maybe it's those 10% that only deserve the financing too, because hey, as much as the let's say lithium price went up 10 times, so did the amount of juniors too. So do your research. Marcos, that ties into being a veteran fund manager yourself. Are we going to see a growth of specialized funds focusing in critical minerals that can help to deploy capital as long as they're seeing capital come into their funds?
I think we're already seeing this. And if we look at the last decade, I think the numbers and the assets invested, specialized in mining and critical minerals and junior mining have declined in a massive scale. But I think this is slowly turning. We have seen some dedicated mining and commodities funds raising significant amount of capital, both on the public side, but also on the private equity side. And I think looking at the nature of some of these early stage companies or exploration or development projects, you need a combination of private and public money to come in and de-risk a project and take it into eventual production. So I think we are seeing, especially because critical minerals are better understood, at least in terms of their applications and uses in electric vehicles or renewable energy, I think investors are more open to invest in them. And I think the funds that are allocating assets are raising more money. And I think that's very important. One thing that I wanted to mention, which relates to the ability to raise additional funding for some of the junior miners, the offtake, as Amanda mentioned, is key. But I would also look at strategic minority investors, whether that's OEMs or larger mining groups that are taking minority stakes in some of the smaller miners. I would look at government support. Only a week ago, we saw the Department of Energy allocate $3 billion in the US to a very wide range of projects and companies. And some of them are junior mining and metal companies. And also the track record of the team. But I think there are key elements to look at in order to see where this new money will go and which companies will have the funding to support themselves to production.
Yeah, there definitely is new money coming in, interested in critical minerals. It's just how it filters down to the juniors. But Marcos, what kind of questions do you ask these companies then? When you're at a conference like Resourcing Tomorrow, what are the key questions that you or even the attendees should be asking these companies?
So for me, I'm a big believer in investing in things that one understands. So if you don't know anything about the metal and don't understand, what the company is doing, I would say stay away. But for investors that can select a universe of companies where they understand the metal, they understand the technology they're applying for for extraction, and they're comfortable with the jurisdiction, I think then one can go further in and look at how close they are to production, have they confirmed their resource, and who are their partners at the end of the day that can take them to production. In my view, and I have done a number of Greenfield projects as well as Brownfield, there are a lot of opportunities around the world today for projects that need optimization but provide a lot of upside to investors. And I think that's what I would look at. You don't necessarily need to go to a new exploration project to get exposure to an asset. There is a very wide range of existing projects that need optimization and redevelopment.
Oh, absolutely. A lot of development projects out there. One could argue that they've been around for years too. So maybe take that slightly more cautious, safer approach. Paul, let's get you back in here then, talking about jurisdictional risk, because that's always a topic in mining resource companies broadly. Look, governments around the world seem very supportive of critical minerals. They all have their own funds and capital allocations to it. How do you go about analyzing and discounting certain geopolitical risks?
We're looking at a scenario across all of the raw materials out there because of the geopolitics around the world, where we're getting essentially two parallel supply chains being developed across economies, all the way from the raw materials sector, whether it's mining or agriculture or fuels and energy and that sort of thing, all the way through the midstream processing and then through the manufacturing to the end consumer. Two parallel total supply chains, those which are more or less Asian focused or non-democracy focused economies, and those that are Western democracy focused economies. That said, there are allies that are consistent with either of those supply chains as individual chains and won't deal with the other. There are other parties out there around the world which choose not to change sides, that take sides and would prefer to be a supplier or a participant in the deposits in the markets of either of those supply chains. And that is fine. We really need that kind of cooperation, I think, across the whole world if we're actually going to get the targets met in 2050. You can't pick and choose ideally, but you can as far as your investment is concerned, and many investors choose to do that. When we, as our firm, when we look at the geographies and geopolitical risk, we're looking at essentially two aspects: how variable or how often does the political environment around tax and around the permitting and so forth in an area where these deposits lie, how often does that change according to changes in who's in power at the time, and how controversial is that particular government in that particular country as far as dealing with its neighbors and its suppliers and its financiers as well. The more volatile those relationships are, the less likely that an investor will otherwise be able to see their investment through in order to get the profits out of it that they hope to, regardless of how good the deposit might be. We also see too that very, very seldom is it that the company that actually finds the deposit is the same company that ultimately makes money on it. It isn't uncommon in the junior space where the companies are immature and very small and otherwise not supported by cash flows in order to find and develop these deposits. It's very common, we see, that at least 4 or 5 different companies are involved in the life of this particular deposit and project before it actually comes to production, if in production at all. So we have these kind of variables that professionals can help you choose, but it takes an awful lot of experience to know what has happened previously as well as what to expect going forward.
Okay, so as a professional, what stage of company do you focus on then? Where do you find the sweet spot for investing right now?
We find a sweet spot for investing where much of it has always been is where is it simplest in order to make money? And That might be at the production side because it's a very simple to process deposit or it's very high grade, or it might be something further into the midstream as far as processing is concerned and not at the mining stage, or at the stage where you're trying to push it along in through the permitting stage and something like that, but something that's already permitted but just hasn't been financed enough in order to bring it to production at this stage. And then the third one is where deposit has already stumbled or a company has stumbled in some regard in the past, but the deposit remains good and it just needs a new management team and a new focus of financing and optimization of the project in order to make money. Those three places are places yet to make money and always have.
Yep. Amanda, I heard you wanted in here.
S&P put out some very interesting analysis of the mining sector recently on how long it takes the average mining project to go from exploration to production. And this is average. And it said that to go from, and this is the ones that are successful, totally discounting the ones that don't make it, which there are many and are the majority. But it takes on average 15 years to get from a resource into, pouring metal out the other end. In nickel, it takes, I think, 16.5 years to get through that development curve. And as Paul said, there are a million points. That's very few investors on the planet, not even private equity guys, have that long to go. So what you see is people becoming specialists and picking their spots. In my opinion, having been in this market for far longer than I'd like to admit, there's two spots where people tend to make money, which Paul alluded to. The first is the riskiest side, and it tends to be the speculative investors, but it's in finding the resource, in the early exploration. That 1 year between drilling it out and having nothing, just hopes and dreams, and actually finding it, the market will often reward you for that year. Then the hard work happens, like expanding the resource, coming up with an engineering study, getting permits. And that's, the next 10 years of this company's life. And very few investors have that kind of a timeline in front of them. And inevitably, almost without fail, these companies will stumble due to markets, due to an unexpected rare insect that they didn't know was breeding in the pond on the back. There's a million reasons.
So many reasons. Oh yeah, I hear you.
And sometimes it's just the market's really bad right now, or the commodity price is really low. So if you lithium, we were talking about critical minerals. So there's when the lithium prices went up 10 times, suddenly there were 10 times more juniors and guys out there getting money to explore for lithium. Maybe 30-40% of them actually found a lithium deposit. But once the prices crashed down, of those, maybe 10% were actually economic at the new pricing model. But there are good lithium prices. But every single lithium junior in the world came down with the lithium price. There was a few of those that were gems that had actually seriously progressed their project in a high commodity price environment that could then be picked up for a lot less money. And that's often, and once they've gotten through a lot of those permitting hurdles, and they need last mile capital or last couple of mile capital, that's often a great place to make money in our industry. And frankly, a lower risk, exploration, as Paul will tell you, is more art than science. If you can pick a winner, you do great, but I'm not sure that it's hard. Making money in exploration is hard. When you do it, the returns are amazing, but it's too risky for my blood most of the time.
Fair enough. You need to deal with a lot of losses in that aspect. But Amanda, even on something like lithium, that market, how much in your eyes is DLE going to change the overall supply demand metrics, especially on the supply side? And how much do you think it will be a winner takes all type of system, somebody who can actually develop DLE technology that works at low enough costs?
Well, it's been found. I'm afraid there's a huge misnomer in the market that effective DLE is not possible. The Chinese are the largest lithium producers in the world, and them and the Australians, they have lots of it. And they have been successfully extracting lithium from brine economically, even at these prices today. But it's their technology, and you have to license it from them because they've been, frankly, they invested time and effort in developing technologies that worked before the West realized it was important. So there is lots of examples out there of economic DLE, to my knowledge, and this changes every day. The only economic DLE technology that's presently being commercially applied is in China. How long until Western direct lithium extraction units can compete with the Chinese technology? I don't know. But DLE has been cracked. It just hasn't been cracked by us.
Yeah, there's a lot of companies working on DLE too. A lot of pilot plants out there being run. We'll see which ones make it in let's say the Western world to commercial scale. Marcos, bringing you back in. Out of all the critical minerals out there, some of which get added to government lists, which ones do you see the brightest future for? Which ones, as a fund manager, are you most focused on?
I don't want to speculate on this because invariably whatever I say will the opposite will happen. But I can tell you that in my work I have been focused on nickel, and that has been I would say a painful experience in the last 2 years because we have experienced extreme volatility. At the same time, even in a market that has been very tough, I still think now there's a lot of opportunities in nickel because the market is beginning to stabilize. The participants in the market that could not survive have stopped production, and the new needs of the market are shaping up. To give you an example, whereas a few years ago producing assets or production, let's say related projects would be the most valuable prospects in a portfolio, today ore assets, supply of ore, exportable ore, are the most valuable assets in the market. So, and again, another example, again in the nickel space, good technology is extremely valuable now because it can reduce cost and expand the markets into battery minerals, whereas just old production, even successful production on its own, does not have full value. So I'm giving the example of nickel, but I think that applies to other markets as well. I think there's a lot of opportunities. I think the price drops of the last year provide a good entry point in lithium, in cobalt, in nickel. So based on what I said earlier, I would look to build a diversified portfolio across critical minerals with companies that have strategic partners that can take them somewhat part of the way towards monetization, with the understanding, and I think Amanda mentioned it very clearly, that assets may change hands multiple times before they go into a steady production state.
Absolutely. Okay, so one of the themes that I'm hearing here too is a bit more advanced companies that have strategic backers, companies that do already have assets. Paul, what about you? Any other of the critical minerals that you're really focused on? Any other stages of companies that you see opportunities in?
Yeah, a couple of things I would mention. First of all, the commodities of silver and tin. Both of those are very high growth rates as far as the commodity use is concerned. In the case of silver, it's the photovoltaic sector because it is a photosensitive material to transfer ions of light into electricity, and that's for the solar PV market in particular. The other is as well is for silver is it is part of the electronic connectors. It is the coating on the connection points, which goes across all of our electronic devices. And along with that, as far as silver is concerned, is tin. And what tin is used for, again, is this solder for those connecting points across all of the electronics that we use. Now, silver in its own case has been in deficit for some years now, where the actual demand and usage by volume has been over and above that has actually been in annual production. It's about the 5th year now we're in deficit, and that's perceived to continue as the usage growth rate seems to be going faster than our means globally to produce silver. In the tin space, that's tended to be more logistically and geographically focused into a few areas in particular in the past that are now getting much more not exhausted, but otherwise moving into much lower grades and much higher costs. It used to be produced to a great extent in Southeast Asia, but the environmental damage that the deposits that those have undergone for their nations just aren't as tolerable anymore, and the grades just aren't as high anymore in order to do that. So the rest of the world otherwise has to find tin deposits in order to meet its needs. The other business model I would address or encourage investors to consider and address is those companies which take less risk on the exploration side and look at the royalty and streaming sector, because that sector in particular has shown itself to be very successful in being successful businesses over the last 3 decades. And what that simply does is those companies essentially buy a small percentage of the actual cash flows from individual successful mines across the world in whatever commodity they are. And the accumulation of these royalties in companies and therefore these cash flows has proved to be a successful business model. Now, I would add the caveat as well that the successful companies of the future, whether large and small, will be those that we identify now, or that we should say as our children and grandchildren would identify now as those which are most sustainable. Sustainable being how conscientious is this company, this business, this management in order to produce this material, not only at a profit, but also to benefit its community in the local level, its environment in which it is trying to extract this material, and the future use and reuse of the commodity and product that they produce. That particular measure will be one which becomes increasingly important for the profit for investors going forward.
A very good comments there, Paul, and a couple different angles for investors to look at for these different companies. Look, this has all been very informative, but let's all loop it around to that Resourcing Tomorrow conference in terms of what each of your goals are to get the most out of Resourcing Tomorrow. All conferences that you go to, but since we're talking Resourcing Tomorrow, since it is focused on critical minerals, Amanda, I'll start you with this wrap-up question then. What are some of your goals? How do you get the most out of the conference?
So critical minerals, as we discussed earlier, are more about supply chains, and they're complex. Getting a critical minerals project into production is a slightly more complex argument, and there's lots of different aspects of that argument. For lithium, how are you going to extract it? How much is it going to cost to extract? Is it in a politically stable place? When you put that many people into the same room or conference hall, as it were, we certainly wouldn't all, again, the people that attend that, you certainly wouldn't fit them in one room. But you get to look at all of the aspects of investing of the supply chain that's going to create and develop the next generation of mines. And it gives you a much better picture. So when you see one lithium company, it gives you, its argument for how it's going to do what it's going to do. But when you see 10 lithium companies, you can compare and contrast and get a really good feeling and become an educated investor. And you're sitting in the audience listening to a panel of, let's say, lithium developers. You get the right questions asked, questions you might not have thought of. And I think when you bring that many people together, that's when it gives you the best insight into what is a fast moving and developing industry. And I think conferences like that is where you can see not just lots of companies, but you can compare and contrast all of their development plans to try to figure out which ones have the best chance of success.
Okay. Hey, very good advice. Go listen. Go there and listen. Sit in these panels, especially. Marcos, what do you do? Maybe even more on the company front to get the most out of this conference.
I mean, for me, having attended the event and interacted with companies there, I think the key element is that you have the full range of smaller companies. You have representatives from the larger companies, from the majors, from the traders, as well as representatives from the governments and the policymakers from around the world. And I think this is a very valuable gathering because these different communities come together. And for me, the maximum value, both for investors but also for the companies themselves, is understanding how they can leverage these different stakeholders, build alliances, and see how they can take their projects forward. Obviously, it's extremely efficient to meet so many companies in one go. That's it saves a lot of time and it's very interesting. But I think for the companies themselves, other than attracting investors, I think they can build some very interesting strategic alliances and get a great view of the policy-making environment that affects them both in their local countries where they operate, but also globally.
All right. Thank you, Paul. Wrap us up then. What are you going to be doing at the Resourcing Tomorrow conference to get the most out of it?
I'm looking for the particular projects which are driven by passion of managements, which are driven by simplicity and by as far as making money is concerned. And next of all, you're not actually investing in a deposit, you're investing in the management. So I want to know that the management impresses me as knowing what they're talking about and oftentimes is already experienced, but not as all the time, to actually make me want to be a part of their company.
Okay. Absolutely. Look, going to these conferences, not only do you get thought leaders, but you also get the chance to talk to management teams. If you're investing in the company, talk to these management teams, ask them really whatever questions you want, and learn more about their assets, their projects, and their sectors. Everyone, thank you very much for tuning in and listening to this webinar. Again, Amanda Van Dyke from the Critical Minerals Association, Marcos Camhis, Managing Director, FOS Associates, and Paul Renken, Senior Geologist and Equity Analyst at VSA Capital. I was your host, Corey Fleck. Thank you all for tuning in. And look, I hope to see you all at Resourcing Tomorrow, again, in London, December 3rd through 5th.
Thank you.